Jason Riley, and my next guest is Professor John Taylor of Stanford University and the author of First Principles, 5 Keys to Restoring America's Prosperity. Welcome, Professor.
Good to be here. Thank you.
So in your op-ed for the Wall Street Journal today, you focus on monetary policy and you criticize the Federal Reserve for being too interventionist, for trying to sort of fine-tune the economy. What do you mean by that? Are we talking about quantitative easing policies? Are we talking about purchasing mortgage-backed securities? What do you mean by that?
That's a big part of it because there's such a huge amount of purchases that the Fed has undertaken at this point. It's really unprecedented. But also included is the period in 2003, 4, and 5 where they held interest rates very low, I think added to the boom and the risk-taking, which ultimately created a bust in the crisis. But also now, in terms of interest rates, while there's indicators that interest rates should begin to rise, at least soon, there's this every indication that they're trying to say rates should be low, even zero, to 2014. So those are all interventionists compared to the kind of policies that I think worked well. A lot of economists think worked well in most of the 80s and 90s, where you could describe the Fed's actions pretty clearly. They were focusing on price stability primarily, beginning with Volcker and then through much of Greenspan's term.
So your argument is that, or I should say your narrative for what got us into the financial crisis is the Fed keeping rates too low for too long, and it's a mistake they seem to be repeating again.
Can you hear me now?
Are you there, Professor? I'm sorry. Your narrative, as I understand it, for how we got into the financial crisis is that the Federal Reserve kept interest rates too low for too long, and it seems to be a mistake that they're repeating now.
It seems to be at this point, and I think there's generally a wider recognition that those extra low rates, that extra easy policy led to the boom and ultimately to the bust. And now, as the economy is picking up and we're seeing more signs of inflation, then there's every indication that the Fed should also make those adjustments, but instead we're pledging to hold interest rates very low. And that is an interventionist in a sense, not the kind of policy that worked well much of the 80s and 90s.
You also took issue with sort of the size of the Fed's portfolio, how it's grown and swelled in recent years. And I think Bernanke's defenders would say that these, are emergency responses that we had to make at the time, and Bernanke assures us that he will draw down this portfolio over time. What's your concern about the Fed maintaining such a large portfolio, and do you think it's going to be tougher than he realizes to draw it down?
Most certainly, because it will require selling large amounts of mortgage-backed securities and medium-term treasuries is exactly the time where there's going to be upward pressure on those interest rates. So politically, it will be difficult. Moreover, if it's pulled back too quickly, that could be damaging too, because it could be contractionary. So I describe the situation now as one where there's undue risk because of this extra amount of intervention. And on top of all that, there's speculation, of course, every day whether there's going to be another quantitative easing, when it'll be, how much there will be. And that causes uncertainty and raises questions about what the Fed is actually going to do. We're right now in a new type of monetary policy. We haven't seen it before. I think that creates risks and uncertainty, and the Fed should sort of lay out a plan to get away from that kind of policy.
Okay. Now, you want the Fed to be focused on price stability and sound money. Are you saying there's no role for the Fed, or that the Fed should not concern itself with stimulating business investment and consumer spending, particularly for big ticket items like housing?
The Fed should concern itself with the overall economy, with strong recoveries. It should, of course, be cut interest rates when there's a recession. It should provide the lender of last resort responsibility. But no, it should not intervene into particular markets like the mortgage market or the automobile credit market or the student loan market. That's really the responsibility of the Congress through the appropriation mechanism. There's no reason to have an independent agency of government taking on such a huge amount of power, and it ultimately has unintended consequences which can be quite damaging.
What about the argument that an exclusive focus on price stability could lead to higher unemployment, particularly in the short run? And we already have unemployment above 8% and higher if you count people who are underemployed or have even stopped looking.
History shows exactly the opposite. Remember, one of the reasons the Fed held interest rates too low for too long in 03, 04, 05 was a concern about unemployment in the short run. But the result of that ultimately was a financial crisis, which has led to extraordinarily high unemployment. And we've seen this in the past. So often when the Fed tries to do too much, tries to look at the short-run movements in the economy, it does things which ultimately make things worse. So I think a focus on the Fed on its responsibility, which is long-run price stability, doesn't preclude actions to cut interest rates, lender of last resort, but it does remove the excuse, if you like, of these extraordinary interventions which we've never seen before.
Okay. Kevin Brady, a Republican congressman from Texas, has introduced some legislation called the Sound Dollar Act that you wrote a little bit about in your op-ed. Would this measure address some of your concerns, and how so?
I think it does, and I'd say three ways. One, one you asked about, which was the focus on long-run price stability, would remove a lot of the extra incentives for the intervention. Second, it would preclude certain types of purchases by the Fed on large amounts of mortgages, and focus the Fed on Treasury securities, its tradition. And third, I think it would have a way to really spread the responsibility amongst all the district presidents, not just the New York Fed president, in terms of making this decision. So the Federal Reserve System as a whole could be involved in outlining a good strategy for monetary policy. Those are three things in the bill that I think are quite promising, and I'm glad that we're having a discussion about those in the Congress.